Welcome to About Money, a different approach to investing you won't hear anywhere else. Your hosts, the AFC team, Mike and Al, are registered investment advisors who have a proven track record of managing long-term investments surpassing the markets. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's your AFC team, Mike and Al.
Good afternoon. It's Saturday, and we're talking about money. We're going to speak Scottish today. We're going to talk about the Scottish Mortgage Investment Trust. If you haven't heard of it, it's a 114-year-old privately owned fund.
Same guy's been running it the entire time?
Yeah, he's 119. It's a $17 billion fund, and these guys are cutting edge. They were early investors in Amazon, Tesla, Moderna, ASML. And the reason why I bring this up is because it lines up to what we do, and it's been around for they've been doing the same thing for hundreds. They haven't changed. I don't know what they invested in 114 years ago. You and I can speculate. Automobiles, electricity.
All of that.
Right?
Computers, all those. And
now, to the people listening, say, okay, who cares, right? Really, who cares? Well, over the last 10 years, their 10-year they're up 325.
Which is not a bad return.
No. Right now, they're down. The reason why the article picked up the article, because they're trading below their NAV, their net asset value. They're trading below it by about 20-something, 22, 23%. So the fund is basically on sale. But these are guys that, and gal, they keep their investment, folks. They don't get mired down in the mud of trying to change things to, let's jump to this, let's jump to that, they don't do that. They stuck to their philosophy, and they know, they state right in their information. You can go look at their fund. They state right in that there's going to be times when we're not going to outperform the market. We're going to significantly underperform the market.
I think when you look at not just the Scottish fund, but any number of people who have been managing money for a long time that have been beating the market, that's true of every single one.
Yeah, we did a show on Warren Buffett's performance when he underperformed the market. But I always think it's so fascinating to look at these ones that have been around so long. Why have they been around? Why have they stood the test of time? And because it's 114 years old and they've been doing the same thing, it's just a testament to a strategy that works. Like the other day, Mike, I went to my gym and I was talking to two guys that I know. I walked up in the middle of their conversation. You'll get a kick up. What were they talking about?
So what were they talking about?
Trading and shorting the market. The guy's telling me how he shorts the NASDAQ and then goes long in the NASDAQ and trades the NASDAQ. And he's making a killing. You know what I always say to those people when they start getting into, they find out what I do, and I'm saying, my last statement is, okay, show me your 1040. I haven't seen one yet.
Oh, yeah. I remember talking to a person who was claiming a 40% per year return.
Yeah.
And I said, I'm not doing anywhere close to that. But, as we talk, I said, where are we talking? And he says, well, I was thinking about putting maybe some money. I said, so how much total do you have? 140,000. And I'm thinking, wait a minute, how much did you begin with? Well, pretty much 100,000. And I'm thinking, you've been doing this for 10 years and have a 40% per year return? I said, that's 40% over 10 years.
Yeah.
But if you look at advertisement, you look at a number of things, and we've been to trade shows where you have firms that are saying our clients make money. I believe that's really true. I believe it's true of newsletter writers. I believe it's true of most financial advisors. I believe that most people make money. It's not a question of making money. It's a matter of how much you make. And the point you bring with the Scottish fund is right on. They're outperforming the market. Not every year, not every 2 years.
No, but they don't get scared out of it. They hold their stocks for years, sometimes even decades, waiting for these things to mature, like a fine wine, right? You don't drink the Bordeaux right when you pick it off, right when it comes out with its vintage. You set it down if it's a good year, 10 years, 20 years or whatever. It improves and goes up in value, and you have your wine story. You can tell your wine story. I've heard it 3 times now about the great wine you bought that you thought it was rot gut.
Oh, I did.
I know. You said you opened it. You bought it for I forget what you paid for it, and then you said it was the worst wine you've ever had. A year later, you opened it again and said it was the best wine you ever had.
So yeah, the story. Okay, so now I have to elaborate.
Now you gotta tell the story now.
So we lived in France. My wife and I lived in France for a while. We used to go back to France every so often, and we were there. My wife was a French teacher, and so we took students to France. And we were there in the summer of 1994, and it was a really hot. And the French winemakers are only allowed to bottle a certain number of cases. And so if you have a really hot year, you have to prune the grapes back. If you have a cold year, you push the grapes as many as you can get. But in a hot year, the grapes really blossom and the wine becomes very concentrated. That's why the variation so much in wines in France, much more so than in the U.S. But anyway, 1994 was a really hot year. 2 years later, we're back in France, and we were invited to some people that own Chateau Lagrange. And as we're sitting there, as we're walking through the fields, looking at the vines, I asked the winemaker, I said, 1994 must have been a spectacular year. We were here in the summer. He said, it would have been, except that just when they began to pick, it started to rain. He said, 1995 is going to be a much better year. So given that information, that's like having inside information. I bought a case of Lafite, a case of Margaux, a case of Le Bon Pasteur, and a case of Troplong-Mundon, all of which I had some connection. The Wine Spectator came out a couple years later and said that the 1995 Margaux, they rated it 100 out of 100. They said it was the best Margaux since 1902. Now, I'd paid $80 for it in the future market. It was selling for over $1,000 a bottle. I'm thinking, I've really done it. So 2001 comes around. I've got the 12 bottles of this wine in our wine cellar. And I'm thinking, we had a sad occasion. I think, okay, I'm going to break out the Margaux and we're going to pour it and have something really positive. So I poured the 1995 Margaux, and it was maybe one of the worst wines I've tasted. I would have rated it a 70, not 100. Wine Spectator rated 100, said it was the best since 1902.
Did you just put a paper bag around at the time? And good.
So in 2002, I tried it again, and the same thing. So I thought, this is selling wholesale for $1,000 a bottle. I'll trade it for something that I really like. But I never got around to doing it. But one of our friends was involved in getting things for an auction. He said, would you donate some wine? And okay, I can donate Margaux and get a write-off on this. Even if I take it wholesale, it's a nice write-off if I take it retail. So I donated several bottles of wine. And who bought it? But a friend of ours bought it. And they said, your wedding anniversary is the same time as ours. We'll get together and have dinner. And I'll bring, the reason I bought the Margaux, he said, is so that we could have dinner and drink together. And I'm thinking, oh my gosh. How do I explain? And this happened a couple of weeks before the dinner happened. And for 2 weeks, I sat there cringing, wondering how I'm going to explain, because they paid a really good price for the wine. So came the night of the dinner. I'm thinking all through the beginning of the dinner, what am I going to say? What am I going to say? They're going to know as soon as they taste this wine that it was really bad. And they know that I've already had a couple bottles of it. So they know that I already know it's really bad. So I brought up a bottle of Lafite to begin with, and we had the Lafite, which was superb. But then we opened the Margaux. And as we opened the Margaux, I'm thinking all the time, how am I going to explore? Poured the Margaux. I tasted the Margaux. That's the best one. Something happened in between 2001 and 2018 that turned it into what always amazed me is how would somebody know in 1998 that bottle of wine would be a super bottle. But anyway, that's the story of the wine.
But that leads right into the stock.
It does.
It leads right into yesterday. I watched 2 conference calls, Mike. One was so-so. Stock got hammered. One was excellent. Stock got a little bit hammered, but still down. The stock should be up 15, 25. And it's down 3%. Now, am I going to move in the... No, I'm still confident that the long term is good for these companies. But that's just how the market is. Like the wine, right? Until it hits that time and that peak, you don't know.
You have to look at the long term. If you're really going to make money in the market, it's looking at and it's looking for the great stocks as well as the great wines.
Right. And it's like the friends that I ran into at the gym, they were talking about trading the NASDAQ. And I'm like, he trades the NASDAQ 100. I'm like, if he just buys the NASDAQ 100, probably holds for 15 years, he'll probably be much better buy and sell it.
Oh, yeah.
He might think he's making money because he's snipping, he calls himself a swing trader and he's going to snip $100 here or $1,000 there.
It's like Warren Buffett said, the stock market is a mechanism for moving money from the impatient to the patient.
Exactly.
We're going to come right back after this break. Don't go away. We've got so much more to discuss. We want to talk about automation. We want to talk about what's going on in our industry.
About money with your AFC team, Mike and Al, on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
So we're back. And moving on from the Scottish fund, looking like we do, trying to look forward at stock, where things are going. Everybody's hype right now is AI, and my question is how they're going to monetize AI, how they're going to make money off. But with that, we look at the changes in technology, robotics, things that are coming down the pike are coming faster than we know that.
And they're coming not only fast, but in unusual ways.
But one place, I look for places, Mike. I walk around, I look for places, because a buddy of mine sent me a LinkedIn thing. He says it was a picture of people standing in line, and you just experienced. They were at the airport waiting for a rental car, and it dawned. I mean, I had the same thing happen to me last year, and you had a similar.
And we just did as well.
And it's like, wait a second, why can't I get online, fill all this stuff out? They know who I am. They have all my information. If I don't want the insurance and the protection, I can decline it and go there. There's a kiosk. I push in a couple buttons, or put my thumbprint or my face recognition. I pick up the keys, walk in. Why do I got to stand there I think I stood for an hour in line last.
So I belong to Hertz, and Hertz has and so you bypass a lot of the lines because the car's already set up all the information. But they should be able to do that for everyone.
Right.
And they should, if they were really smart, they would set up 3 lines. If they want to do the gold for certain people, do that. It's like frequent flyer card. But then they should have a line for people whose information is all correct. Everything is set. They can just walk up, get the keys, and walk out.
And most of the cars are keyless, right? And most of them are, they give you some sort of deal, but they're keyless. And you'd put a code in, right? Because you put a code in the door and you get in, and that's it. You're gone.
So, as we were standing in line, I was watching people as the desk clerk or whatever rental person was talking to people, and they were looking at maps and they were drawing things out. And I'm thinking, that's really nice service. But what it does is it discourages other customers who are just waiting to pick up the car and go.
And then you get there because you went to my fair city, Boston.
Yeah.
They have to ask you, do you want the toll pass? Well, come on, just put the toll pass in there. The Massachusetts charges you for everything anyways, right? You're gonna go through the toll. If you leave the airport, you're going through the tolls.
Right.
There's no point in not taking it for the extra $10 or $15. Just add it on to the cost of the car and call it good.
Yeah, but they have to ask that. They have to ask if you want the insurance, if you want to upgrade. But all that information can be filled out in advance.
Exactly.
And done.
Exactly.
And so for people that want to spend time talking to somebody about the maps and where they want to go and about the last vacation and about what the weather is, they can stand in line and talk to somebody.
But my experience, though, that the clerks got so frustrated because there were so many people in line, and they were handling Avis, budget, dollar, and all of them. They had like 2 clerks handling. The line was probably 25, 30 deep. It was taking 45 minutes line. The clerks were getting really frustrated because they couldn't get to people. And then if there's one hiccup, everything shuts down.
Yeah.
So everybody's waiting.
And I don't think it's bad for somebody to wait in a line an hour if they haven't reserved a car in advance. Right.
That's
okay.
But this is places where innovation, things can take place, upgrade these markets much efficient, where we could see drastic changes. Companies, especially since your Avis is bankrupt, they're still going through bankruptcy. They come out of this.
Yeah.
So
in bankruptcy still.
They're still in bankruptcy. That's our thought. So, but this is places where who's going to dominate and come through that market? Someone who makes these type of changes is going to have a huge advantage of a company that doesn't make these.
And I think the real point that we're talking about is what we're doing at Adams Financial Concepts, what the Scottish Fund is doing, what a number of people who do well in the market are looking for the automation, are looking for the changes in technology, in lifestyles and demographics, efficiency. Mm-hmm. And when you stand in line and you stand there for an hour or 45 minutes, you know that something is going to change. It's not a question that it's going to continue ad infinitum. You know it's going to change.
Yeah, and I did a little looking into it because I was curious about a business at the airport work. There's not a tremendous amount of security. It's not like you have to go through TSA to get a business. There's nothing like. I'm sure there is, but it doesn't stop them from doing the things they're talking, because if you're traveling, you've already gone through all that and been vetted anyway, so there's no need.
But the idea is to look at things where there's inefficiencies and then look for the companies which are going to solve the issue. And then to invest in those companies.
And it could be a new company that we haven't even heard of today could come into that market and just like, Uber did for the tech dominant.
And the chances are it is going to be a company.
Yeah.
the rental car companies have had this problem. It's not a new problem. It's been a problem for years and years. In fact, if you look at the enterprise model, Enterprise, when they entered the car rental market, looked at what was going on and decided they were going to take a different approach. And their success came because they delivered the car to the renter. Rather than waiting for the renter to come pick up the car, they delivered it. Now, that doesn't work at the airport, but that's the kind of innovation they were looking at. But when you look at the lines and look at what's going on, you know that somebody's going to come up with a way to solve that. And the chances are not very great it's going to be a car company or a rental company. It's going to be some guy sitting in his kitchen or going to college who says, I've spent an hour in line. I'm going to write a program to eliminate all that. You know, that's part of what was called in a book called Bold, is a time of digitalizing, taking a physical product like standing in a line and turning it into a digital issue. And what we just described in terms of what Al's just described of taking all the information and setting that up, that can be done digitally. That can eliminate the lines, you know, and you can eliminate the physical product in a very large source. What we've seen with Lyft and Uber and Airbnb is not only is it a digital program, but it can be uploaded to the cloud. And we're going to see more of those things that happen.
And in a tight labor market, getting people to work that solves a lot of those. A lot of these jobs that you and I talked, 3 or 4 million jobs aren't filled. They might just go away. Now, does that mean the job market's going to shrink? You and I don't think so. We think that more jobs are going to be created.
More jobs are being created every month.
Jobs that didn't exist a year ago.
Yeah.
And I saw an hour-long interview Elon Musk talk. Things that didn't exist a year ago. Those jobs didn't exist a year ago. Now there's a whole new industry for AI and all these other things that are existing.
And if you look at it, you know, I relate with this story of my wife and I for Thanksgiving flew to California to see my daughter's family. And we were at a restaurant and there was a little QR code on the table. And during COVID, you saw a lot of QR codes come up because it replaced the menu. But they took it a step further because not only did you get the menu, but you ordered using the menu. And when everything was done, you paid for everything. So that there were only 2 people serving about 30 in the restaurant. There was one person that was pouring drinks, coffee or orange juice or whatever you wanted for breakfast. There was another person in the kitchen nuking the food and delivering it to the table. 2 people serving 30. Go into most restaurants and see there's 8 or 10 people. That's complete labor saving. And there's a new company called Cucina, Due Cucina or something like that. Went to it in West Seattle, where they have a list of pastas, a list of sauces, and you pick a pasta, you pick a sauce, you pick your drink, you pick everything out. It's fresh pasta. They're making fresh pasta right there.
It's not the old, like what's that one in the 50s, the automat?
Yeah. I mean, the concept is similar.
But fresh, but not something that's packaged, that's sitting in a shelf, right?
Yeah.
That's sitting in some little refrigerated box, something fresh.
Fresh product, fresh pasta, fresh locally grown sauces and so on.
Mm-hmm.
And you pick up everything.
You mean locally grown tomato? You can't.
Those concepts are coming. And it's not for fine dining, but it's for casual dining. And that's a significant market. And you can do that by reducing the labor dramatically. We want to look for those areas where you have automation, where they're disrupting what's going on. Most people don't realize. Most people don't even think about what's going on. And, you know, that's one of the things that we really do. We look at what's happening around us and where the automation is happening and how we can take advantage of that. We're looking for things that are disrupting, that are changing an industry. I think people have estimated that 45% of all current jobs are at risk of being replaced. At the same time, there are new jobs being created. But we talked about the restaurant. We talked about the car dealer or the rental car. It's looking for what can be done. Don't go away. We've got more to come.
About Money continues. Remember the website, adamsfinancialconcepts.com. Here's your AFC team, Mike and Al.
So we've been talking about what's going on in the market in terms of industry, in terms of what's going on around us. Put it in the time frame. There's somewhere between 5 and 6 million jobs, more jobs than there are people to fill those. And eventually that number will come down. Either it will come down because we find people coming into this country, maybe through immigration, or it'll come down because we figure out how to automate 5 million or 6 million or 7 million or 9 million jobs. And that's what we started talking about. We talked about the rental car where things can be done. We talked about restaurants. It's a time where we live in a time where if you can make something digital, you can replace the physical aspect. And most people don't realize what's happening. When we talk about robotics or when we talk about automating things and robotics, people think about R2-D2 or C-3PO. And there are some of those robots that are being made. They're being made as caregivers for replacing those people working with nursing homes and with older people. Those robots can actually toilet a person. They can dole out the medicine. And even they have cuddly little robots that will carry on a conversation.
Have you seen the commercial with the one with the little girl with the cuddly little robot that's supposed to?
I haven't seen.
You know, she was a shy kid and all these type of, build this scenario, and then she's been playing with, but I can't think of the name of it, but this little robot that giggles with her and moves with her and does all these things and mimics her movement.
Yeah.
And now she's opened up and blossomed.
No, those robots are coming. But a lot of what's going to be automated is not going to be a robot. It's going to be the things like the QR code.
Yeah, but what about like things, the way I think of it and what I've been, CPAs, right? The tax code is pretty much stagnant. It changes every year a little bit here or there, and then it's done. You don't have to think of it. But if we have machine learning that can sift through that 25,000 pages in a second and figure things out, are those type of things going to go away?
Sure it is.
Law, right? Lawyers and stuff who have to sift through massive amounts of legal cases and things like that. Does it help that industry? Do we need as many lawyers as we have?
I mean, think about what's even happened in the legal time frame. In the legal area, it used to be that you had paralegals who would dig through documents and documents and documents. I can't remember off the top of my head the case. It was CBS was being sued for monopoly. Mm-hmm. And to go through and dig through all the documents took something like 6 months. There was a case that followed that, maybe 10 years later, same amount of number of documents, but this time it was all run through a computer. It took less than 2 weeks to sort all those data.
And now they can do the same in probably minutes.
Yeah.
And when we get the advent, like where this is going, we talk about AI, but what I think is missing is when the convergence AI and quantum computing, you'll be able to sift through that type of data and iterations of getting drugs approved and medical technology. It's going to be astounding what they'll be able to do and see.
Oh, yeah, because computers have an astounding ability to manipulate data.
Yeah, but the ones we have now are finite in comparison to what they can do with the quantum computing. The quantum computing is basically my limited knowledge of quantum physics, but basically be in two places at once and do two things simultaneously. Oh, and the more they add to it, it's just exponential how many problems they solve within a second.
Oh, yeah, and it's going to get more and more so. But that brings us to the point of talking about AI.
You can't not talk about it. I mean, it's all everyone's talking about.
Everybody's talking about it. It's the very hot investment. It reminds me in many ways of the dot-coms.
I sent you a company this morning that I read a big article about that they think is kind of a fraud.
Yeah, but I remember there was a machine shop that came public during dot-com days. A machine shop had nothing to do with the internet. They weren't on the internet. They didn't have anything to do with it. But they decided to add to the name .com at the end. MachineShop.com. I don't remember the name of Machine Shop, but they got a valuation that was 5 or 7 or 10 times what they would have gotten had it been just a machine shop that came public. Nobody just having that aura that it had something to do with the internet blew the price up. Today, when companies talk about having AI, it just blows the price up, and it becomes a feeding frenzy. It was a feeding frenzy with marijuana, and we go through these feeding frenzies. So what is AI? Let's talk basically, if you look at what AI is. I think almost everyone, if you look at what things are, you've seen debates where they take the debate and they take the number of words that are said and they make a chart, put all these things together in a collage. And the more one word is mentioned, the bigger it is in the collage. And so the idea is to see from that collage what the emphasis was. If somebody mentions democracy 95 times, democracy comes out in big letters. If they mention $1 once, it comes out in really tiny letters. That's essentially what AI has done, is they're able to take all that information and plug it in and do the words and associations with the word and make that collage. And then when you plug in words, it fits all those together.
Yeah, it's kind of interesting you mentioned words, because some of the news I was watching this morning on these, because this is earnings season. Companies a quarter ago that never mentioned AI, there was studies saying, oh, this company now mentions AI 57 times in its conference call.
Oh, I know.
Right? You go read the annual report from last year. It might mention it. One I just read this morning, it might mention it once, but I'm sure the next one is going to read 50 or 100 times will be AI.
So AI, artificial intelligence, real artificial intelligence is learning kind of thing where you actually have decisions made. Artificial intelligence is Big Blue playing Kasparov, which is an interesting story too, because when Big Blue played Kasparov, the first time he won. The second time they played, the computer partway through the game moved the rook to the d5 square. And if you play chess, you know what the d5 square is. And if you don't play chess and don't know what the d5 square is, just say that it's moving the rook, one of the chess pieces, a couple squares. Kasparov was so confused by that move, he could not figure out why the computer did that move. He pondered and he thought about it, and he couldn't, no matter what he did, he couldn't see it wasn't an attack, it wasn't a defense. He couldn't understand that move, and it bothered him so much that he lost that game. In fact, it set a psychology moment for him for the entire match that he eventually lost. And what that move was is the programmers, when they programmed Big Blue, they thought, if there's not a move to the benefit, or we'll just make an innocuous move that's not damaging to the position. There was no reason behind the move, except psychologically it crushed Kasparov. Think about that.
It's like, you throw a deep interception in the opponent's territory on third down, right? You throw an interception at the 3 or 4 yard line. There's really no advantage. You're not going to gain anything, but you're not going to lose anything, and you put them in a bad position.
Yeah.
Just to confuse them.
So, that's talking about AI. You have to, Al, you raised the question, how do you monetize it? How do you take advantage of it?
Nobody really knows yet. I've looked at one company that is producing second, but all these other companies, the one I sent you this morning, I looked at them and read some of their stuff, and they basically say they're not they mention a little bit about machine learning, but they say their machines are there to help humans make decisions. Well, that's not AI. AI is the opposite of that. It's making the decisions based off of whatever algorithm or whatever code they put into the machine.
Well, yeah, you could say that computerized trading is AI.
Yeah.
Because it grabs a whole lot of data, makes the decisions, and has no human interference.
But when it goes south.
Yeah. But there are companies that, some of the companies we own in the last conference calls, have talked about their AI approach. When you think about it, it's not AI.
No.
It's just hype.
It's a lot of them sifting through, having their machines sift through data at a faster rate, so then humans can then make decisions based on data.
Yeah.
The machine is not sifting the data and then saying, do this, do this, do this. The machine is saying, here's this, and here's the probability of this and this, and what do you guys want? What do you want to do?
So one of the stocks we have is scans and has camera technology. And they talk about AI by if you see motion, the cameras focus in on it. That's not AI. That's just, Anyway, it's nice in the conference call and everybody says, oh, wow. Anyway, it's not really there.
Not yet. It's It's coming, but it's not there yet for companies to monetize money on.
Yeah.
I think because ChatGPT is charging people $20 a higher level version. That's the only place I see monetizing. And then there's one other company that does produce computerized bots and do computer tasks you don't want to do with data.
Anyway, don't go away. We're going to come back and talk about our industry, because there's things that are going on you should be aware of. Don't go away. So we've been talking about automation. We've been talking about what's going on. We've been talking about the Scottish Fund. It's done well. There have been a couple articles that I've read, and I'm trying to track down the basis of the articles. But basically what they said is that if you look at all the registered investment advisors, if you look at all the registered reps at major firms, that what's happening is that the organic growth has slowed down dramatically. Growth that was 5 or 6 or 7 or 8% in the early teens, 2010, 2012, 2014, has slowed down to 3 or 4%. Now, when we talk about organic growth, what it means is how the accounts are. You take all the money that's coming in, and that's either new accounts opening up, or it's people adding money to their accounts, or the growth in the value of those accounts. And you subtract out the people that are moving the accounts out. And in this business, one of the reasons people move their accounts out is because they die. They actually don't accounts, but the inheritors do, or some will. And you have income that's going out of accounts. You have all those things that are going on. Distribution, it's money in versus money out. And that's slowed down to a couple percent. And a major reason for that is return. And in my opinion, a lot of that comes down to what's gone on in my industry with most financial advisors. Not at Adams Financial Concept, but many firms are looking at how much money each account makes for the firm. And they actually break it down and classify. And so I happen to have the information from a fairly large firm, and they break their clients down into A+ clients, A clients, B clients, and C clients. And they have a very big definition. An A+ client has $4 million or more in assets under management. An A client has $2 million in assets, but less than $4 million. A B client has at least $500,000 and the potential to become an A or A+ client. And a C client has less than $2 million and will never have $2 million or more, which already says something about the firm, right? That already says something. A+ clients are treated in a different way than an A client. A+ clients get access to the client portal and a holistic view of finances. Everybody gets that, including the C client. The A+ clients get real-time updates on their plans, and everybody has a plan at this firm. So do the A, the B, and the C. The A+ clients get budgeting information and cash flow analysis. So do the A and B clients, but not necessarily the C clients. The A+ clients get a wealth management review. So do the A clients. And so do the B clients, because you want them moving up to A. The A+ clients get a monthly curated content on their investments and planning talks. And that goes for A and B clients as well. And to a limited degree, C clients. But then the A+ clients get three in-person reviews a year. They get an investment review in quarter one. In quarter two, they get a financial planning meeting to update everything. In quarter 3 and 4, they have tax meetings and miscellaneous meetings. If you're an A client, you only get 2 of those meetings. If you're a B client, you get that meeting on the phone, and you get 2 meetings on the phone. But if you're a C client, you just get 1 meeting on the phone. So the A+ clients are the ones that also get a concierge handoff. So when the tax documents are prepared, the financial advisor will walk them to the CPA and walk through it. That's only for A+ clients. A clients don't get that. B clients don't get that. C clients just get their regular 1099. No tax planning at all. And the A+ and the A clients both get surprise gifts, and they get invited to events. The B clients don't get invited to events, or usually don't get invited to events, and usually they don't get surprise gifts. And the C clients get none of that. And that's how it breaks down for those firms. Their focus is on providing information based on how many assets you bring and how much revenue you bring to the firm. You know, when I looked at that, I thought about that. I like clients that have $500,000 because we want to turn that $500,000 client, those C clients, into A+ client. Not that we would do a breakdown, not that we classify clients. We treat all of our clients in the same way. An $8 million client is going to get the same reviews as does a $100,000 client. I have clients that started with as little as $30,000, now have half of it. A client that started with $400,000 that's taken multi-million dollars out of the account to do a business. The idea is we have a passion for creating and maintaining wealth. Client, not advisor wealth. You know, if you look at what's going on, I believe that a lot of the reason why in this industry we're seeing a slowdown in organic growth is because the whole focus is on surprise gifts, events, and really focusing on those clients that have $4 million or more in assets. And most of those clients don't need to grow their assets if they do, but it's the clients that are $500,000 or $1 million or $1.5 million, $2 million that need to grow their assets, or $100,000. And that's where we go. That's what we're about. We want to see our clients grow their asset. We want to see those that are at the top end maintain those assets. We want them to be prepared. We think we're going to go through a really, really difficult time for the next 8 to 10 years. I've been invited to speak about, of all things, fixed income or income next week at the Northern California Family Office event. And I thought about one of the questions that will be asked is, what do you think will be the 10-year Treasury in 6 months or a year? And my response is pretty straightforward. I think the 10-year Treasury has a good chance to be above 5. The big risk is that it's going to go up, not down. I believe that we're going to continue with inflation. There's not going to be a recession. The Fed's going to continue to deleverage their balance sheet. Wars are fought slowly and end quickly. The war in the Ukraine could very well be over within 12 months, maybe within 6 months. And when that happens, the panic rush and the rush to quality is going to be over, and people are going to sell those long-term bonds. So you'll have the Fed selling, you'll have hedge funds selling, you'll have a lot of people selling bonds to go for growth. I think we have a very different approach, a very, very different approach. And I think it's to the benefit of our clients. Just our thoughts, just to make a point of what's going on in the industry. It's a very different time. The growth that's coming to most financial advisors and most financial firms is because they're buying and rolling up because they're planning. Anyway, that wraps us up for this week. Have a great weekend and a great week, and we'll be back next week to talk about